I've been thinking. The S&P 500 has gone through a bunch of fluctuations over the last couple of weeks. And I know that some folks who have a mind to invest and improve their finances have been experiencing some sort of trepidation about whether or not they should still be invested in such an index, such an instrument. As I'm sure you know, over the last couple of weeks, the S&P 500 has dipped under 5,000 points. It eventually climbed back up. But that sort of volatility can cause some investors to get a little bit queasy. Here's why I think you should never be queasy when investing in broad-based index funds such as the S&P 500, and why, me personally, I'm always going to continue to invest in the S&P 500, even as I expand my investment horizon into other things. Well, namely, one thing I want you to think about is long-term growth. The S&P 500 has shown consistent growth over the long term, despite short-term fluctuation. If you go all the way back to the founding of the S&P 500 index, I think it was 1967 was the founding, and you take a look at the growth of the index since then, it's kind of an interesting journey, right? You definitely see all the individual recessions that have happened, early 2000s, 2008, 2009 crisis, 2020 when everything was shut down and sort of a big drop happens. But you also see that during the period of time, the trend line is always sort of on the up and up. I guess the other direction is how it should go, right? The S&P 500 is always on kind of the up and up. I'm not sure which direction it's going to look up to you, but you know what I mean. It really is sort of an axiom of investing in general, investing in U.S. stocks in particular, or even investing in real estate. It seems as though if you stay in for the long haul, the investment always appears to more or less go up, if you have the stomach and if you have the patience to deal with the minor fluctuations. That's probably one of the biggest reasons why you should keep plowing money into the S&P 500. But then there's the power of dollar cost averaging. So we talked about the fluctuations that happen with the S&P 500 every now and again, right? The S&P 500 goes up, then it goes down thanks to some recession, some economic phenomena that happens, including the current economic phenomenon that we're experiencing, which is inflation causing higher interest rates causing the economy in general to not be as performant as it could be. But by simply investing a fixed amount regularly, you can buy more shares when prices are low and fewer when prices are high. This reduces the average cost that you accrue acquiring stocks over a long period of time. And that definitely speaks to something that I think a lot of people overlook when they invest, right? Discipline is one of the big things that a lot of people miss and a lot of people simply don't acquire on their way to getting more financial success. The one thing that's key amongst all people that accomplish any goal of any sort, whether it's getting in shape, keeping your finances up to date, growing your finances and becoming a wealthier individual, is that you need discipline to maintain any sort of momentum for success. So when the market experiences a dip, a disciplined approach would be, okay, the market is going to dip a little bit here. Let me invest a little bit more. Again, helping with your dollar cost averaging, but also keeping your investment muscle strong, helping to keep you focused on your long-term financial goals and just not short-term market movements. Another great reason to be invested in the S&P 500, and one of the reasons why it keeps going up, is simply because of its diversity. Now, I will say this. Diversity with investments is kind of an overrated concept. If you're really going to grow your wealth, you need to find the right investment that's not so diverse. For example, anybody who started a business and had it succeed, that's not a very diverse investment strategy. Anybody who's gone all in on a particular stock and seen it grow exponentially, that's not a diverse investment strategy. Diverse investment strategies are sort of the safe way to go if you want to invest for the long term, which is smart. As a matter of fact, if you're going to be a wily-eyed investor who really goes out there and takes a risk on a single stock or starting your own business or getting into a crypto of some kind, that sort of thing, it probably behooves you to also have a portion of your investment put away into a broad-based index fund like the S&P 500 or Russell 2000. That way, you don't have all your eggs in one basket. A form of diversity. That being said, diversity is not all bad, particularly when it comes to, like I said, safe, broad-based investments. And the S&P 500 includes a diverse range of sectors and companies, helping to spread out your risk of losing money even as the market dips and particularly when it rises. And as I'm sure you know, this diversification means you're less likely to be severely impacted by the performance of any single company or sector, helping to provide a built-in safety net. The capability of index and index funds to inherently adjust to changes within individual markets as particular players that perform well or perform poorly, and how that changes over time. That's one of the beauties of indexed funds and ETFs in general. So it's definitely a good reason to focus on those sorts of things, and particularly broad-based indexes and ETFs, such as the S&P 500. And the truth is, this reflects the economy in general. You can consider the S&P 500 a benchmark for the overall health of the U.S. economy. Like I stated before, if you look at the S&P 500 and you look at its history, you'll notice that as time goes on, you can start to pick out individual points and markers in the history of the U.S. economy as it goes down, as it continues to go up, as it goes down again, as it continues to strive higher and higher. And you'll notice that as the economy recovers, so does the S&P 500. So you can catch positive economic shifts and policies. But you can also see the negative economic shifts and negative policies as the S&P 500 continues to go over time. So if you're the type of person that just wants to set it and forget it and kind of just follow the normally upward trajectory of the U.S. economy, then just putting your money in the S&P 500 is the way to go. Keeping in mind that investing is a marathon, it's not a sprint. The key to growing your wealth is to invest consistently over time. Growing your wealth is not like playing the lottery. Sure, it is possible to win the billion-dollar lottery, but it's not likely. If you apply a consistent, disciplined approach to investing, you can definitely grow your wealth from wherever you start. And as you apply more and more discipline and more funds to your investment strategy, which should be relatively simple, and if you're playing it safe, diverse, your wealth should grow steadily over time. And as a matter of fact, it should compound steadily over time. So you just have to keep in mind that short-term volatility is less significant when your gaze is on long-term goals. And that if you stay the course, history shows that patient investors are typically rewarded. So any kind of market dip that you see, including the one where the S&P 500 drops under 5,000 for a period of time, you can view that as normal, and you simply adjust your buying opportunities. What I do is I just continue to buy, and I don't even pay attention to the value of my portfolio at the time. And as I'm sure you're watching this video, the S&P 500 could be on a major tear downward or a major rip upwards. But the point is to keep investing if you're playing it safe, no matter what the circumstances are. Now, I have done videos on individual techniques that are not as safe as investing in the S&P 500. Individual stocks, technical analysis, day trading, that sort of thing. Be sure to subscribe to the channel for more videos on that very topic. And like this video if you got any value out of it whatsoever. And like I tend to say at the end of these videos, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on your goals, and I'll catch you in the next video. Derek West for Finance Squared. I'm out of here. Peace.